GWW Grainger, the industrial distribution giant, 4 million MRO products delivered to maintenance, repair, and operations customers across North America and Japan through a B2B model built on availability and speed.
FY 2025 revenue $17.2 billion. Q1 2026 revenue $4.742 billion beat estimates. EPS 11.65 crushed the 1031 estimate by 13%.
GWW Grainger was founded in Chicago in 1927 by William Wallace Grainger, selling electric motors and parts to factories. By the 1950s, it became the leading industrial distribution catalog.
Grainger moved online early, launching Grainger.com in 1995, one of the first major B2B e-commerce platforms. Today, over 80% of orders are placed digitally.
Under CEO D.G. Macpherson, Grainger built the endless assortment strategy, expanding Zorro in the US and Monotaro in Japan to serve the long tail of smaller MRO customers online.
High-Touch Solutions generates approximately 78% of revenue, serving large enterprise and government customers in North America with dedicated account management and guaranteed product availability.
Endless Assortment contributes 22% through Zorro.com in the US and Monotaro in Japan, targeting smaller customers with a marketplace of tens of millions of SKUs.
FY 2025 revenue $17.2 billion at 12% operating margin. Grainger has increased its dividend for 55 consecutive years, one of only 29 S&P 500 dividend aristocrats.
Q1 2026 revenue $4.742 billion beat the $4.621 billion estimate. EPS 11.65 crushed the 1031 estimate. FY 2026 revenue guidance raised to $19.4 billion.
Fastenal and MSC Industrial Supply compete in the MRO distribution segment. Both are smaller, more specialized in fasteners and metalworking respectively, with less product breadth than Grainger.
Amazon Business has entered MRO distribution with marketplace convenience. Grainger competes on reliability, availability, and account relationships that Amazon's marketplace model cannot fully replicate.
Grainger's moat is availability and service reliability. When a factory floor goes down at 2 a.m, the local Grainger branch and next-day delivery is the only acceptable answer.
Grainger operates over 600 branches across North America, supported by massive distribution centers, with Monotaro making it the dominant MRO platform in Japan as well.
Monotaro in Japan is the second-largest industrial marketplace in Asia. Over 46 million active SKUs, serving small and medium businesses with same-day and next-day delivery.
D.G. Macpherson has served as chairman and CEO of Grainger since 2017, previously chief operating officer, where he led the digital transformation and endless assortment strategy.
Macpherson holds degrees from Middlebury College and Harvard Business School. He joined Grainger in 2008 and has led the company through its transition from catalog to digital-first distribution.
GWW Grainger, the industrial distribution giant, $17.2 billion in FY 2025 revenue, serving millions of MRO customers across North America and Japan with 4 million products, guaranteed availability, and 55 years of consecutive dividend growth.
Q1 2026, revenue $4.742 billion beat estimates. EPS 11.65 crushed the 1031 estimate by 13%. FY 2026 revenue guidance raised to $19.4 billion, EPS guided 44.25 to 46.25.
GWW Grainger beat Q1 earnings estimates by over 14%, one of the largest positive surprises in industrial distribution in years. The company is not glamorous. It sells nuts, bolts, safety equipment, and industrial supplies to businesses, but it is executing at a high level. Today, we break down a company that quietly compounds at double-digit rates while most investors focus on sexier industries.
GWW Grainger was founded in 1927 in Chicago by William Wallace Grainger, who started by distributing electric motors. Today, it is North America's leading broadline maintenance, repair, and operations distributor. Grainger stocks over 10 million stock-keeping units and serves more than 4 million customers globally, from small contractors to the largest industrial companies in the world. It is the supply chain safety net that keeps factories, data centers, and infrastructure running.
The business model is industrial distribution. Grainger earns a margin on every product it sells, sourcing from thousands of manufacturers and selling to customers who need the products delivered reliably and on short notice. The value proposition is breadth. No customer wants to manage relationships with hundreds of individual suppliers when Grainger can be the single source for almost everything. That breadth justifies the premium pricing that drives Grainger's margin structure.
Revenue for Q1 2026 came in at $4,742 million, up 10.1% year over year. Analysts were expecting approximately $4,400 million, a 7+% beat on the top line. High-touch solutions, the large customer segment, grew strongly, and Zorro, Grainger's digital marketplace for small businesses, continued its above-market growth trajectory.
Earnings per share of $11.65 crushed the consensus estimate of $10.21, a 14% positive surprise. Gross profit was $1,896 million, for a gross margin of 40%. That gross margin improvement reflects the mix shift toward private label products and the effective pass-through of pricing in the customer base. Operating leverage was exceptional in the quarter.
Zorro is the digital growth engine. This online marketplace for small and medium-sized businesses targets the long tail of industrial distribution customers that Grainger's traditional branch network underserved. Zorro's selection, competitive pricing, and digital ordering experience have built a rapidly growing customer base. Revenue from Zorro has been growing at above 20% annually, and the business is reaching scale where unit economics are improving meaningfully.
Monotaro, Grainger's Japan-based industrial distribution marketplace, is the international analog to Zorro. Japan has historically been underserved by broadline MRO distributors, and Monotaro's digital-first model has resonated with Japanese small and mid-sized manufacturers. It is now one of the largest MRO e-commerce platforms in Japan and is expanding into Southeast Asia, extending Grainger's digital playbook into adjacent international markets.
CEO D.G. Macpherson reaffirmed full-year guidance and highlighted the infrastructure demand tailwind. Data center construction, electric vehicle manufacturing, semiconductor fabrication plants, and federal infrastructure projects are all driving incremental MRO demand from customers in Grainger's service geography. The company is adding dedicated sales resources to capture this incremental large project demand, which tends to be concentrated and high value.
D.G. Macpherson has been CEO since 2016 and has overseen Grainger's digital transformation, investing in Zorro, building out e-commerce capabilities for the core business, and expanding Monotaro. He has consistently prioritized operational excellence over growth at any cost, which has resulted in margin expansion alongside revenue growth, a combination that most industrial distributors struggle to achieve simultaneously.
The bull case is non-discretionary demand and digital penetration. MRO supplies are not optional for factories and data centers. When a critical component fails, it gets replaced immediately, regardless of budget constraints. Grainger's depth of inventory and delivery reliability make it the default choice for customers who cannot afford operational shutdowns. And as e-commerce penetration of industrial distribution increases, Grainger is positioned to capture the shift with Zorro and its own digital capabilities.
Private label is the margin expansion lever. Grainger has been aggressively expanding its house brand product lines, safety equipment, cleaning supplies, tools, where it can offer comparable quality at a lower price point than branded alternatives while capturing higher gross margins. Private label now represents a significant portion of total product revenue, and that share is growing, creating ongoing positive mix effects on profitability.
The bear case is the industrial cycle. Grainger's revenue tracks manufacturing production and industrial activity. In a genuine recessionary scenario, factory shutdowns, reduced industrial output, inventory destocking across the supply chain, MRO demand decelerates. The company performed relatively well in the 2020 COVID disruption, but a sustained industrial downturn would pressure revenue growth and create volume leverage in reverse.
The digital competition risk is real but manageable. Amazon Business is aggressively targeting the MRO market, offering competitive pricing, broad selection, and prime delivery. Grainger's response has been to lean into the advantages Amazon cannot easily replicate: deep technical expertise, dedicated account managers for complex customers, and the ability to manage entire MRO programs at enterprise scale. The SMB market is more contested. Zorro competes directly with Amazon Business for that segment.
On the balance sheet, Grainger has a clean investment-grade capital structure with moderate debt and exceptional free cash flow generation. The company returns the majority of cash to shareholders through consistent dividends and share buybacks. Capital allocation is disciplined: investment in digital capabilities, selective bolt-on acquisitions, and returning excess cash. The balance sheet provides significant financial flexibility in a downturn.
The bottom line: Grainger delivered an exceptional Q1 2026 with the largest EPS beat in the sector, driven by pricing power, operational leverage, and digital business momentum. If you want exposure to industrial infrastructure with a defensive MRO foundation, a digital growth overlay, and a management team that executes consistently, Grainger belongs in the conversation. It earns its premium multiple. GWW Grainger's business model is worth understanding precisely because it is often mischaracterized as simple industrial distribution. Grainger is actually a supply chain services company disguised as a distributor. Its large customers, hospitals, manufacturers, universities, government agencies, do not just buy products from Grainger, they outsource their MRO procurement function. Grainger manages the product catalog, purchase order processing, inventory stocking, and compliance tracking. The annual contract fees and volume commitments create revenue that is stickier than typical wholesale distribution and less sensitive to spot pricing.
Monotaro, Grainger's Japanese subsidiary, is a high-growth asset that most U.S. investors underweight. Monotaro is the leading online MRO distributor in Japan, with over 7 million SKUs and over 3 million registered customers. Revenue growth has averaged 20% annually over the past 5 years, driven by market share capture from traditional catalog distributors. Monotaro's operating margins are lower than Grainger's U.S. business due to investment mode, but the TAM expansion in Asia is significant. If Monotaro replicates even 40% of Grainger's U.S. market penetration in Japan, it becomes a business worth over $10 billion on its own.
The EPS beat in Q1 was driven by gross margin expansion, a counterintuitive result given that commodity inflation is still present in the supply chain. The explanation is Grainger's pricing discipline. Grainger raised prices in 2023 and 2024 ahead of competitors and has been selectively passing through cost increases to customers under long-term contracts. Customers who tried to switch suppliers discovered that Grainger's service level, same-day delivery for tens of thousands of SKUs, was not replicated by competitors at any price. That operational gap is the source of Grainger's pricing power.
Capital return at Grainger is a quiet part of the bull case. The company has increased its dividend for 54 consecutive years, placing it in the elite category of dividend kings. Beyond dividends, Grainger has reduced its share count by approximately 30% over the past decade through buybacks. Management has indicated a continued preference for buybacks at current valuation levels. For a business growing earnings at 8 to 12% annually with declining share count, the intrinsic value per share compounding is faster than the headline EPS growth rate implies. This is financial education, not personalized investment advice. Industrial distribution involves cyclical, competitive, and operational risks that require individual analysis. Please review Grainger's SEC filings and consult a licensed financial professional before making any investment decision.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.